Green loans are lending instruments designed to finance projects that deliver clear environmental benefits. Similar to green bonds, the proceeds from green loans must be allocated to eligible green projects, such as renewable energy installations, energy-efficient buildings, clean transportation systems, sustainable water management, pollution prevention initiatives, and climate adaptation measures. Green loans have become an important component of sustainable finance markets because they provide borrowers with flexible financing solutions while enabling lenders to support environmental objectives. Banks, development finance institutions, corporations, municipalities, and infrastructure developers increasingly utilize green loans to fund projects aligned with sustainability goals and growing stakeholder expectations regarding environmental responsibility. The green loan market has expanded significantly alongside broader growth in sustainable finance. Regulatory developments, climate commitments, investor demand, and corporate sustainability strategies have contributed to increasing issuance and adoption. Green loans are particularly attractive for borrowers seeking financing for specific environmental projects without accessing public debt markets. Financial institutions benefit by aligning lending activities with sustainability objectives and demonstrating support for climate transition efforts. The market also supports the mobilization of private capital toward environmentally beneficial activities. As climate-related risks and opportunities become more financially material, green lending is expected to play an increasingly important role in financing sustainable economic development. Sustainability-linked bonds, SLBs, and sustainability-linked loans, SLLs, differ from traditional green financing instruments because they are not restricted to financing specific green projects. Instead, these instruments link financing terms to the achievement of predefined sustainability performance targets. Borrowers commit to measurable environmental, social, or governance objectives, such as reducing greenhouse gas emissions, improving energy efficiency, increasing renewable energy usage, or enhancing diversity metrics. If performance targets are achieved, borrowers may receive financial benefits, such as lower interest rates. Failure to meet targets can result in penalties. This structure encourages continuous improvement in sustainability performance across an organization's entire business rather than only selected projects. The sustainability-linked loan principles and sustainability-linked bond principles provide internationally recognized frameworks that promote credibility, transparency, and consistency. These principles are generally built around several core components. First, sustainability performance targets must be material, ambitious, measurable, and relevant to the borrower's business activities. Second, key performance indicators must be clearly defined and capable of objective measurement. Third, financial characteristics should reflect performance against sustainability targets. Fourth, borrowers are expected to report progress regularly and transparently. Finally, external verification is encouraged to enhance credibility and investor confidence. These principles help reduce greenwashing concerns while supporting accountability in sustainability-linked financing markets. Sustainable funds, green funds, and other sustainable finance products provide investors with opportunities to align capital allocation with sustainability objectives. Sustainable funds typically incorporate environmental, social, and governance considerations into investment selection and portfolio management processes. Green funds focus specifically on investments that support environmental objectives, such as renewable energy, energy efficiency, climate solutions, and pollution reduction. Other sustainable finance products include ESG-focused exchange-traded funds, impact investment funds, climate transition funds, sustainability-linked investment vehicles, green bonds, social bonds, and blended finance structures. These products allow investors to pursue financial returns while supporting environmental and social outcomes consistent with sustainable development goals. The integration of ESG and climate considerations into investment and lending decisions has become a central feature of modern financial markets. Investors and lenders increasingly recognize that sustainability-related factors can influence risk profiles, operational performance, regulatory exposure, reputation, and long-term value creation. ESG integration involves systematically incorporating relevant environmental, social, and governance information into financial analysis, portfolio construction, credit assessments, and risk management processes. Climate considerations include evaluating physical risks, transition risks, emissions exposure, climate strategies, and resilience capabilities. By integrating these factors into decision-making frameworks, financial institutions seek to improve investment outcomes, strengthen risk management, identify emerging opportunities, and support the transition toward a more sustainable global economy.